Well, that's a very difficult question to answer precisely. Let me explain the history really of what's gone on with alternative investments. And that is that in the past, by that I mean the 1990s and 1980s, many alternative investments were really the purview of the very wealthy and the very large institutions. And they did this with private placements, with limited partnerships. And to get involved in those products takes, in my judgment, a tremendous amount of due diligence and sophistication. But what happened, especially in the last 5 years, is that the SEC became wise to the idea that investors needed more alternatives than the standard traditional mutual funds that were available. Mutual funds are a great investment vehicle, but mutual funds were focused by SEC regulations, largely speaking, on traditional strategies. You couldn't implement alternative strategies in mutual funds. So the SEC changed the rules, allowing firms to be more flexible and to bring some of these strategies into the mutual fund space. That's great, because that means that the ordinary investor can invest in these products, and they're more regulated and they're more constrained. And I think that it's much easier to evaluate these alternative investments when they're inside of these mutual funds, rather than trying to evaluate them when they're limited partnerships, where they're privately organized investment pools that are available only to the wealthy and the institutions. But with that came a large number of these mutual funds. It seems like everybody is dragging out a new idea for a mutual fund and is marketing it. So how do we differentiate between, how do we understand the difference between the different strategies that people talk about: equity market neutral, credit long short, merger arbitrage, convertible arbitrage? How do we even understand what's going on, and how do we make an evaluation that if you're going to pick a particular type of mutual fund, such as one that has managed futures as an underlier, how do you differentiate between the funds? Well, what we often do in the traditional mutual fund spectrum is we look at long-term return histories. Well, the problem here is that the mutual funds themselves do not have long-term histories. So it's a difficult issue. One of the things we can do, I think is important to look at, is to look at the fees that the mutual fund charges, the alternative mutual fund charges. And the good news is that alternative mutual funds have much lower fees than hedge funds. Hedge funds tend to have very large fees associated with them, and many of the alternative mutual funds have rather modest fees. That's good. Another thing that I like to look at, excuse me, is the management of the company, of the mutual fund. Are the managers of the mutual fund experienced in the alternative sector, or are they new to the alternative space? And obviously you want an investor who's got a good track record in alternative investments for a long time period. So the ideal alternative mutual fund to me is one that has a management team that for many years was very successfully running the private hedge funds, and now they're taking that experience and that strategy and they're moving it over into these publicly available mutual funds. So what I look for in managers, and I spend a lot of time doing this, of course, is people who really understand the strategies, they're experienced in those strategies, they're charging moderate fees, and that they are following a strategy that makes sense in the current environment.